Okay, let's get started on Chapter 9, the Master Budget. How we use budgets today in the business world is we first start off with developing a strategy. The strategy can be a company-wide strategy. It could be even a strategic plan. But when it's all said and done, it's just a way of understanding what is the direction the company is going. The next thing we need to do is build some shorter-term goals and objectives. And how we achieve those goals and objectives is based upon a plan. So after developing the strategy, we come up with a plan. After we have the plan to achieve those specific goals or objectives, we then execute the plan, we act. And then from the action, we then look at ways of seeing how we're doing relative to what our plan is. So then we have a control mechanism, and that control mechanism is looking at how what are the reports that are showing how we're doing relative to our plan. So we'll look at the actual versus budget, and if there are any variances, we can then make a determination whether or not we're on track. So it's as if the PowerPoint knew exactly what I was thinking. So as I mentioned before, the whole budget process begins with the company's overall mission or purpose statement. You might want to take some time out and go look at very large organizations, well-known organizations, and see what their mission is and what their vision is. We're going to develop long-term strategies or strategic goals. We're going to design a plan to attain those specific goals, and that means we're going to develop shorter-term budgets. And then we have what's called a rolling budget, which is a continuous update so that we see how the 12-month operations are always budgeting. So when we're talking about budgets, the one thing we do have to mention is what is referred to as participative budgeting, which means we're looking for a process by which we involve many levels of management. We're not just putting together budgets at the highest level and telling everybody you have to execute this. We're going to get managers involved, supervisors involved, and in some cases we'll even ask employees to become involved. And so lower level managers are closer to the action, so they can be able to give us a lot of guidance as to how this budget what should the budget look like. They're more likely to be motivated by the budget if they help create it. So if you have a lower level manager that gives some input, and the input is followed based upon the budget, then they're more likely to follow along. Some of the things you really need to recognize is that participative budget can be more complex and time consuming. So it does take a little bit more time to put together. And then because you have lower managers participating, they may build in a level of slacks. And then sometimes you have what's referred to as a budget committee that will be a part of this process as well. The budget will then, and the budget committee can be made up of a lot of different individuals from a lot of different departments. So there are a lot of different ways that companies do this. One way is to use prior year budgets or actual results as the starting point. This is very common. It's the easiest way to go. You look at what you did last year and say, okay, well, since we spent $100,000 on wages, as an example, we spent $100,000 in wages, and we're figuring that we're going to go up by 10%, so we'll just add 10% to what we spent last year. And that works. That works. In many cases, it's a good guideline. But we may look at what we got and then modify it based upon new products, maybe new customers, new geographical areas, so that would be increases that we're anticipating. Maybe changes in the marketplace. So if the marketplace is getting better, then we'll move forward. If it's not getting better, then we'll look to see if we can reduce things. Changes in labor or materials, including the costs associated with that. General inflation, we have to take into consideration the fact that prices do go up. And then maybe we've introduced new strategies as part of our strategic planning, so we want to take that into consideration. So we'll start with last year's, and then we'll make some modification based upon these changes. Now that's, again, one way we could do it. Zero-based budgeting means we're going to have managers begin with a zero budget, and then they have to justify every dollar that they're putting into the budget. That's a lot more time consuming. That means you got to just break things down to a very low level so that we're understanding exactly what the money's being spent on. And it takes a lot of time to do that, but it can be done. It's just a matter as to how much time and effort and value you get out of doing those things. There are many benefits to the budgeting process. First of all, it helps or forces the managers to come together, talk about what they're seeing, talk about the trends, gets people doing analysis that they may not do otherwise because they're too busy working on their day-to-day operations. That's one benefit of the budget. The next benefit of the budget is the communication. It allows departments that don't normally interact on a regular basis, it forces them to get together and helps them understand how to coordinate better. And then finally, one other benefit of budgeting is that it creates the benchmark. It creates those numbers that we can look at to compare whether the company is moving in the right direction. Okay, so when we start with the budget, we first start with what is referred to as the master budget. And the master budget is considered to be a comprehensive planning document for the entire organization. So the master budget contains really all of the budgets of the entire company. And so when we say all of the other budgets, we talk about the supporting budgets. And some of those supporting budgets include the operating budgets, and those budgets are needed to run the daily operations of the company. And then we have the financial budgets, which include capital expenditures, cash budgets that culminate in budgeted balance sheet. Now, when we talk about capital expenditures, we're talking about a budget for the purchase of very large fixed assets like trucks, vehicles, machinery and equipment, buildings, land, etc. So the capital budget is all about major expenditures. The cash budget is just managing your cash flow. If we look at a representation, kind of a graphical representation of all the budgets, you'll see that what we start off with is the sales budget. The sales budget really drives the entire budget along, which puts a lot of pressure on the sales and marketing people because they know they've got to come up with something that everybody else is going to be using for their respective departments. After we have a good sales budget, then we can start looking at the production budget. And the production budget can be broken down into 3 specific areas, which we are very familiar with those. There's the direct materials budget, direct labor budget, and the manufacturing overhead budget. We know what these are about, and so we're just talking about a budget specifically for those areas. After we have those 3 areas budgeted, then we then look at the operating budget, which includes all the expenses that we're going to be incurring for the year, but not including direct materials, direct labor, and manufacturing overhead. And then once we have that in place, we then can finalize what is referred to as a budgeted income statement. That tells us what we're expecting in terms of profitability by the end of the year. From then, we can then look at what capital expenditures we need to budget for the year. Again, those capital expenditures are the purchase of very large assets. We're then going to develop the cash budget, which helps us to control the cash. And then from there, we can then finalize what is referred to as a budgeted balance sheet. The top area here, those are all the operating budgets. And then the bottom area, those are the financial budgets. So we'll now look at the sales budget, since that's the first thing we need to be looking at. That's the first thing that's going to drive the remainder of the budgets. We'll first start with the sales budget. Sales budget really commences or begins with the number of unit sales. How many units are we going to sell? Now, if we're just selling one product, then that might be relatively easy. And again, I say relatively easy because even just guessing what you're going to be selling in one unit sometimes can be a pretty tough challenge. But after we have the number of units, we're going to compare that to what our projected sales price is of those units. And with a simple multiplication, we can take the number of units multiplied by the sales price per unit, and that's going to give us the total revenues for the year. So the example we're going to come up with is Tucson Tortilla expects to sell 30,000 cases at a price of $20 per case. Well, I could put up a spreadsheet to show you how this is done, but I mean, that's pretty straightforward. 30,000 cases multiplied by $20 per case gives us the 600,000. Let's go ahead and try pulling one up. Each case is going to be sold for $20 per case. The number of unit sales times the sales price per unit will give you total revenue for that period. So we'll take 30,000 multiplied by 20. And so our total revenues for January will be projected to be $600,000. So from here, all we have to do is just plug in the remainder of the period. Let's see, what do we have? It looks like for February, we're projecting 20,000. I think our sales price is going to stay the same the whole time, so we'll go ahead and just plug that in. And that means that for February, we're projecting $400,000 in revenues. And for March, we're projecting $25,000. And so that means we're going to get $500,000 revenue. So we're just simply multiplying the unit sales times the sales price. This times that gives us this. Now for the quarter, we're going to go ahead and sum the total amount that's expected to get for the quarter, and that would equal to 75,000. And we'll go ahead and use $20 again. And so then for the entire quarter, we're expecting our sales revenue to be $1,500,000. Now, before we go too much further, even though we have our total revenue, we do have to, this is going to be important for us later on, especially when we're using or developing our cash budget. We're going to identify how much of it is actually a sale in cash and how much of it is on credit. So it looks like our budget is going to allow for us to budget cash sales to be 20% and credit sales to be 80%. And then we have cash sales, so that's going to be 20%. We have credit sales, that's 80%. So what we're going to do is we're going to take total revenues and we're going to multiply that by 0.2 for cash sales. And we're going to multiply that same amount times 0.8 for credit sales. We're going to sum this up, making sure that our totals equal 600,000 at the top for the total month. And then let me just copy the format down here. Okay, so we have 120,000 that's expected to be for cash sales and 480,000 expected for credit sales. It's simply just getting this and breaking it down by that. Let's go ahead and copy this over so that we have our total amounts across. So it's 8320 and 100,400. And then we'll sum it across here for the quarter. Okay, so now all the formatting is complete and we have our sales budget for the first quarter ended March 31st. So we'll go on to the production budget. And to do this, we first have to decide how many units the company needs to produce. Well, to do that, we need to also remember and understand what safety stock do we want. The safety stock is just there in case we miss on our projections, right? These units needed for sales, we're going to start off with what we need, what we know we're going to sell. We're going to add to that whatever we want as our ending inventory. And then that's going to be equal to the total units we need. But then from there, we're going to subtract what we're anticipating. You have to remember that we're doing the budget before we've even finished the fiscal year, the one before that. Let's say we start our fiscal year in January. Well, we're putting this budget together in maybe October, November. And so we don't really even know what our inventory is going to be in December, but we have to project it. We'll project out what our ending inventory is going to be. And that ending inventory for December becomes the beginning inventory for January. So we are projecting it. We're projecting that we're going to have so many units in beginning inventory. So let's roll through this again. Units needed for sales plus the desired ending inventory equals the total units needed. This is what we're going to need to sell and have in ending inventory at the end of the period. We're going to subtract from that what we're projecting to have already in beginning inventory, and that's going to give us the number of units we need to produce. The first thing we need to do is figure out the total units the company needs. We know that Tucson Tortilla wants ending inventory to equal 10% of the next month's expected sales. So in this case, that's going to be 20,000 cases. What that means is that we know in January, well, how do we get, let's take a look. How do we get 20,000 cases? Well, let's go back to our spreadsheet. We're going to sell 20,000 cases in February. Well, if we want our beginning inventory for the end of January, or our beginning for February, which is the end of January, to be at least 10% of the following months. So our ending inventory needs to be 10% of the following months. That means we've got to have 10% of the 20,000. That's what the 20,000 means, 10% of the 20,000. So we know we want to sell 30,000. We want to add to that 10% of the 20, which is going to be sold in February. That's what we're planning to do, which is going to be a total of 32,000 cases that we're going to need. We then have to calculate the amount of inventory expected to be on hand at the beginning of the month. Well, if we're following our plan, then when we're planning for December, which is not listed here because we just don't have it, that's not part of the budget plan. But we know that when we put together a December plan, hopefully we know this, that we want to have 10% of January's in play, 10% of January's in play, so that we start off with our beginning inventory of at least 30,000 units. We're going to take 10% of the 30,000, and that's going to be 3,000 cases in the beginning inventory. Okay, so let's go ahead and see if we can put this all together. Unit sales in cases. So what are we going to sell in units? Sales. Well, we can actually pull this up from our sales budget. So that's the beauty of a spreadsheet. We can look up at our sales budget. The total units we want to sell is 30,000. Mind you, why don't we go ahead and just copy that all the way down. We want 30,000 in January, 20,000 in February, and 25,000 in March. That comes from the sales budget. So we know exactly what we want to have ready to be produced. Now, we also want to have 10% of the following month's budget. So let's add to that the desired ending inventory. And our desired ending inventory for January would be 10% of the following month's sales. So we're going to take 20,000 multiplied by 0.10. Now we can do that as well for the following month, February. Since we're planning on selling 25,000 in March, we're going to use that as our desired ending inventory for February. 25,000 multiplied by 2,500, or 25,000 multiplied by 10% gives us the 2,500. Now for March, we don't have in front of us right now what is the projected sales for April, but we can cheat and see what they look. It looks like we wanted 3,200. So I bet our projection for the following month for April was 32,000. But you'll have to be given that in the homework. It's not, you're either given that or you're told what April sales are expected to be. And after that, we have our total needed, right? So we're simply going to add the unit cases that we're going to be selling plus the desired inventory. And that gives us the amounts we need for January, February, and March. Now, for the first quarter, we have to be careful on this. We know that our total unit sales is going to be the sum of the top here. That's our total. This is what we want to sell. But be careful. The first quarter ending inventory is not going to be the sum. It's simply going to be the ending inventory for March. So whatever we're planning on ending for March will be what our ending inventory is for the first quarter. And then from there, we're going to run the sum just like we did for here and see what we come up with, 78,200, which matches what we have here. Less beginning inventory. Our beginning inventory is supposed to be equal to 10% of the current sales or the current month's sales. Or in the example here, in December, we were projecting we were going to have 30,000 sold in January, so we wanted to end December with at least 10% of that. So we're going to take our beginning inventory in this case, our unit sales, and multiply that by 10% as well. So we're looking to have at least 10 or 3,000 or 10% or 3,000 units in the beginning inventory. And then what that means is we can now come up with the number of units to produce. And it makes perfect sense. We're going to sell 30. We want to make sure we have 2,000 at the end of the inventory. So that's the 32,000 we need. So we'll take the 30,000 units that we need. We're going to subtract what we're projecting our beginning inventory to be. And that means what we want to produce for this period is 29,000 units. I'm going to copy that over to February and March. Again, the beginning inventory is actually going to come from, for the first quarter, is going to be the 3,000 that started at the beginning of the quarter, right? So that's going to be 3,000 units, yep, and then 75,200. So that's what we need to produce, 75,200. And just so that you know, the beginning inventory for January is going to be our beginning inventory for the quarter, and that's why you'll see that in the slide, you see the arrow of this coming all the way from here all the way over.